In this learning objective, we describe different ways to measure risk aversion. So thus far, we've seen that we can use a utility function to identify the optimal asset allocation for an investor, provided we're aware of what their degree of risk aversion actually is. But the big question is, how do we actually go about measuring risk aversion? Because risk aversion is an opaque concept that is actually not clearly defined. So if we think about measuring risk aversion, what we can think about are some similar types of concepts that aren't easily measurable, and consider how they're measured. So one concept that might be considered to be akin to risk aversion is pain. We know that pain is something that is suffered to differing degrees when we have different injuries, but pain is also not something that we can't easily measure. We can't just stick a thermometer down someone's throat to identify how much pain that they might be in. So in pediatric medicine, when doctors try to measure the degree of pain that a child is feeling, they use something called a Wong-Baker Faces Pain Rating. And the Wong-Baker scale rates pain from 0 to 5, whereby the child looks at a range of different pictures and identifies which of those images best reflects how they're currently feeling and the level of pain that they're in. So this is an example of measuring a concept that is not directly measurable. What if we move to financial markets and think of how do we measure an equivalent concept like risk aversion? Well, a very effective way to measure risk aversion is by looking at the price some individual investor would be willing to pay to participate in a gamble. One way to think about that gamble, imagine a game of heads or tails. We're at a game of heads or tails where you flip a coin. If it lands heads, you win $100. If it lands tails, you win nothing. And imagine you have to pay to enter that game. Now we know that the expected value of that coin toss game is $50 because there's a 50% chance of a head and a 50% chance of a tail, and we had a payoff of $100 and $0. Therefore, if you were risk neutral, you would be willing to play that game for the price of $50. You'd be willing to pay the expected return in order to take on that risk. However, given investors are risk averse, they would normally only participate in that game if they could pay an amount less than $50. But the amount less than $50 that you would be willing to pay in order to play that game gives you a measure of your degree of risk aversion. So someone who has a very low degree of risk aversion, so an A equal to, say, for example, 1, they might be willing to play the game if it costs them $45 to play. Someone with a slightly higher degree of risk aversion, say 2 or 3, they might be willing to play the game if it costs $40. Someone who is highly risk averse, let's say an A equals to 5, they might only be willing to play the game if it only costs them $15 or $20 to play. So we can translate the price that you're willing to pay compared with that expected value of the risky payoff and get a measure of your degree of risk aversion from that example. Another way to look at the degree of risk aversion of investors is to infer it from their investment decision making. And the easiest way to think about this is to look at how an individual investor allocates their superannuation. So for most superannuation funds, there are a range of different options, a range of different buckets that have different asset allocations, which an investor can choose between. Take UniSuper, for example. UniSuper has 8 different investment choices: cash, capital stable, conservative balanced, socially responsible balanced, growth, socially responsible high growth, and high growth. As we move here from top down to the bottom, we have an increase in expected returns as we move down, but a commensurate increase in risk across each of these portfolios. So if an investor elected to, say, invest in cash or capital stable, we could assume that they're a highly risk-averse investor. If an investor decided to invest in high growth, we could assume that they have a low degree of risk aversion. So thinking about that, we can see as we move down, we're increasing the risk because we're increasing the asset allocation into risky assets, particularly equities. So capital stable has only got 20% in equities, whereas high growth has 72.5% in equities. And we're also increasing expected returns. To think about this choice in terms of utility calculations, let's imagine that an investor makes a choice across each of these asset classes because that is the selection that maximizes their utility. So we can use our utility maximization function to identify what must be the coefficient of risk aversion for that particular investor such that that asset allocation is maximizing their utility. So if we can assume target performance of each of these funds is the expected return of the fund, and we can use the weighting stipulated by UniSuper in terms of the breakup between defensive and growth assets, we can see here, as the allocation in the risky portfolio and the risk-free asset, what we can see is that we can infer, we can back out from this calculation. Here I'm assuming that the market risk premium is 6% and the standard deviation of returns is 20% per annum. We can back out that if an investor is investing in the capital stable fund, that implies they have a coefficient of risk aversion of 5. If the investor investing in a higher growth, that appears to imply that they've got a coefficient of risk aversion of about 1.5. Okay, so we can use the actual decisions, the actual processes made by investors as a way of backing out and calculating their degree of risk aversion. Another common technique, and this is also used by a lot of financial planners, is to use surveys to measure people's risk tolerance. So we can see here as an example of a survey, a range of questions that give a measure of an individual's appetite toward risk. And across each of them, you could add up how many points the individual scores, and we could see different values of points might relate to differing degrees of risk aversion. So scoring very highly means you've got a very low A, so you're an aggressive investor, or you've got a low degree of risk aversion. A low score means you're very conservative, because it means you've got a short investment horizon, you've got you expect your future income to decrease, you've got no emergency savings, and so forth.